What's up, everyone, and welcome back to the Web3 Daily. Today, let's dive right into the latest market action. To be honest, the overall vibe I'm getting from the market right now feels like the calm before the storm. We've got Bitcoin chopping back and forth around that $114,000 mark. It seems like it's struggling to push higher, but whenever it dips, the buyers step in pretty strong. It's a similar story for Ethereum, just hovering around the $4,300 without any major waves. So, what's causing this standstill? In my view, all eyes are on the upcoming US CPI data and the Fed's interest rate decision. Until those two major events unfold, the big money seems to be sitting on the sidelines. You can see it reflected in the market sentiment index, which is sitting at neutral. Everyone's just watching and waiting. In times like these, keeping your hands in your pockets might be the smartest move. It's worth a reminder that short-term market risks are definitely still in play. But while the market is trading sideways, there's a powerful undercurrent building up, a much bigger wave that could be forming. And that's what we're going to talk about today. Personally, I think this is the core narrative that will shape our wealth over the next few years. It's the moment Wall Street giants finally stop testing the waters and start diving in headfirst. I'm talking about tokenization, or as we often call it, real-world assets. We've heard this term for a while, but this time feels completely different. And the main players, BlackRock and Nasdaq, BlackRock's CEO, Larry Fink, has been saying the tokenization of everything is coming. And honestly, I thought it was just talk for a while. But now, they're getting serious. They didn't just stop with the Bitcoin spot ETF. News just broke that they're working with JP Morgan to put traditional ETFs and even stocks directly on the blockchain as tokens. Have you ever thought about that? Imagine buying and selling Apple stock just like we trade Ethereum on a DEX 24/7, 365 days a year with instant settlement. And if you think BlackRock is still in the testing phase, well, Nasdaq just slammed their application right on the SEC's desk. They have formally applied to trade tokenized stocks and ETPs on their own exchange. The signal here is massive. This isn't some small company's pilot program anymore. This is one of the world's top stock exchanges looking to fundamentally change the rules of the game. So why is this all happening right now? I think a lot of it has to do with the current environment. The Trump administration seems much friendlier towards crypto, and the regulatory winds are clearly shifting. These Wall Street sharks have a better sense of smell than anyone, and they see an opportunity to dominate the financial infrastructure of the next generation. We're talking about a market potentially worth hundreds of trillions. Of course, the challenges are huge, like how to integrate with the current centralized clearing systems and how the legal and regulatory frameworks will adapt. But once this door is opened, I don't think it can ever be closed again. The convergence of traditional finance and the crypto world is no longer a question of if, but when and how fast. Alright, after talking about the grand narrative from Wall Street, let's switch gears to a fascinating piece of news. This one feels like a letter sent from the ancient past of the crypto world. Every time something like this happens, it gives the OGs a jolt and leaves the newcomers completely stunned. Just yesterday, a Bitcoin whale address that had been dormant for a full 13 years suddenly woke up. This address was created back in 2011, a time when Bitcoin was trading for less than $1. Inside, it held 440 BTC, which, at today's prices, is worth over $50 million. Just picture that. 13 years. How many generations of crypto users have come and gone? How many projects have risen and fallen? How many people got rich and went broke? But this address just sat there quietly like a fossil preserved in amber. Then, yesterday, it initiated a transaction and moved all the coins to a new address. Now, the funds didn't go to an exchange, so it doesn't look like a dump is coming, but the action itself is enough to get everyone's imagination running wild. The community immediately started buzzing, with everyone guessing who could be behind it. Was it an early developer who finally found their long-lost private key? Or maybe it's just a die-hard believer who decided to move their assets to a more secure storage solution? We'll probably never know the answer. But the symbolic meaning of this event, in my opinion, is far greater than its actual market impact. It's like a living testament, constantly reminding us what the most original and powerful consensus of Bitcoin is: hodling. These 440 coins survived more than a dozen bull and bear cycles, and their final value has likely surpassed the wildest dreams of the original miner. This might just be the purest definition of faith in Bitcoin. After that, look at a living fossil from Bitcoin's history. Let's bring our focus back to the Ethereum ecosystem. Something major just happened here that a few years ago would have been a massive FUD bomb capable of crashing the market. But this time, the market was surprisingly calm. Here's the deal. The staking exit queue on Ethereum suddenly saw an influx of over 2.6 million ETH. We're talking about a value of several billion dollars. What this means is that billions of dollars worth of Ethereum is now in line to be unstaked and become liquid. When I first saw this news, my heart definitely skipped a beat. I mean, if that much ETH hits the market, who knows what could happen? But after digging in, I realized the story is more complex. The main driver behind this massive exit was a large staking provider called Qun. They did this because one of their major clients got hacked. So as a safety measure, Qun proactively decided to exit some of their validators to isolate the risk. See, this isn't because of a problem with Ethereum itself, nor is it a sign of lost confidence. On the contrary, it looks like a professional, institutional-grade risk management procedure. And the most interesting part is how the market reacted. The price of ETH barely moved. What does that tell us? I think it speaks volumes about the maturity of the Ethereum ecosystem and the market as a whole. People no longer panic at the mere mention of an unlock. They now analyze the reasons behind it. Everyone understands that the execute takes time. So it's not like this supply can be dumped on the market all at once. More importantly, the market is starting to see these kinds of risk control moves by institutions as normal, maybe even as a sign of a healthy ecosystem. It shows that the investors who have survived multiple cycles have leveled up their understanding. A potentially massive bearish event was absorbed by the market without a whisper. To me, that says more about the strength of the ecosystem than any price chart. We just talked about the maturity of the Ethereum mainnet. Now, let's zoom in a bit to witness a battle of the titans happening in a specific sector. This clash reveals a profound shift that's currently underway in the world of DeFi. The main character here is one of the hottest projects in the decentralized derivative space right now, called Hyperliquid. They're planning to launch their own native stablecoin, USDH. But here's the interesting part. They're not building it themselves. Instead, they've put out an open call, inviting the top stablecoin issuers in the market to bid for the contract. Whoever wins gets the exclusive right to issue this new stablecoin. And who showed up to compete? Let's just say it's a lineup of heavyweights. You've got Ethena, famous for its breakout, synthetic dollar, USD. You've got Paxos, one of the oldest and most regulated stablecoin issuers out there. And you have Frax, a pioneer that has navigated the world of algorithmic stablecoins. These three arguably represent three different schools of thought in the stablecoin universe. When I saw this, I thought it was absolutely fascinating. This isn't just a technical competition anymore. It's a war over business models and ecosystem dominance. It highlights a few key trends. First, top-tier applications like Hyperliquid have become powerful enough to build their own independent economies, and a stablecoin acts as the central bank for that economy. Second, stablecoin as a service is becoming a real thing. These issuers are no longer content with just getting their own coins adopted. They're now looking to package their entire infrastructure issuance, compliance, reserve management, and offer it to other major protocols. That's a whole new market. And third, it shows the professional specialization of DeFi. Hyperliquid is focusing on being the best derivatives exchange, while outsourcing the highly complex and risky job of stablecoin management to the experts. It's like a car company outsourcing engine manufacturing. The outcome of this competition won't just determine who wins the massive Hyperliquid account. It could serve as a major indicator for the future direction of the entire stablecoin space. Okay, we just covered the battle royale at the application layer. Now let's look at a new trend developing at the public blockchain level itself. You'll notice that in order to secure their ticket to the next institutional bull run, these top-tier loans are starting to get more down to earth. Or perhaps more accurately, more Wall Street. The Avalanche Foundation just dropped some major news. They're planning to raise $1 billion, but this isn't for tech development or ecosystem grants. The purpose is very specific: to establish dedicated treasury companies in the United States to manage the AVAX token. My first reaction to this was, these guys really get it. What are they doing here? They are proactively embracing regulation and paving a super highway for Wall Street's institutional capital. Just think about it. For a US pension fund or a hedge fund dealing with an overseas foundation with a vague legal status to buy and hold a large amount of tokens, how complicated is that compliance process? How high is the risk? Now, Avalanche is setting up a company right on US soil, operating within the legal framework that these institutions know and trust. It's a total game changer. It's like they've built a bridge directly to Wall Street's front door, handing them the money and saying, "Here we're compliant. Come and get it." Behind this move is a major trend in the loan space: corporatization and professionalization. We used to think of public blockchains as these decentralized, community-driven entities. But now, to compete for the real, multi-trillion-dollar prize of real-world capital, just having good tech isn't enough. You need professional legal, compliance, and finance teams. You need to be able to speak the language of traditional finance. From that perspective, the Avalanche Foundation's move is incredibly smart. It might even become a blueprint for other loans to follow. Whoever can solve the compliance and trust problem first is the most likely to get a head start in the next institutional bull market. Okay? We've just been discussing business and strategy. This next piece of news, however, is much more somber. It takes us to the intersection of the crypto world and the real-world politics, where a very influential Bitcoin supporter has met a tragic end. Charlie Kirk, the prominent American conservative activist and founder of Turning Point USA, was assassinated during an event. Many of you might not be familiar with him, but his influence among young conservatives in the US is massive, and in recent years he became an incredibly strong advocate for Bitcoin. Unlike the Wall Street crowd, Kirk didn't promote Bitcoin from an investment return perspective. He approached it from a much grander narrative. He saw Bitcoin as freedom money, a tool to fight back against the government money printing and to protect individual property rights. He treated it as a symbol of certain values. This message resonated powerfully with conservatives and libertarians in America. You could say he was responsible for bringing a whole new demographic into crypto people who were drawn to it for their political beliefs. His sudden passing will have complex and far-reaching implications for the crypto space. In my opinion, on one hand, to his followers, he may become a martyr for the cause, which could ironically strengthen their resolve to hold Bitcoin, viewing it as a political statement. The freedom money narrative could become even more deeply entrenched because of this. But on the other hand, having such a politically charged figure so closely tied to cryptocurrency could also bring negative consequences. His political opponents might use this tragedy as an opportunity to attack crypto, linking it to political extremism. This event has thrust Bitcoin's political identity in the US squarely into the spotlight. It's no longer just a financial asset, it's now a political symbol. This will have unpredictable effects on its future regulatory paths and its broader acceptance in American society. After that heavy political topic, let's end with a piece of news that's full of innovation, bringing our focus back to the core of the Web3 industry: technology and application. Even though the public blockchain landscape seems pretty established, there are still new challengers trying to enter from a completely new angle. Solving a problem that we haven't paid much attention to, but which has enormous potential. A new Layer 1 public blockchain called Camp Network has just launched its mainnet. Now, this isn't just another general-purpose chain trying to compete with Ethereum or Solana on speed or ecosystem size. Its goal is very vertical, very focused, to build an on-chain intellectual property or IP management and monetization platform for the creator economy and the age of AI. I think their timing and focus are spot on. Think about it. How do musicians, artists, or influencers make money from their work right now? A vast majority of the profits are siphoned off by platforms and all sorts of middlemen. And with the rise of AI, there's going to be a flood of AI-generated content. Who owns the copyright to that? How do you prove something is original? These are massive problems. Camp Network wants to use blockchain technology to solve this. Put your IP on-chain. The ownership record is immutable, and all royalties and revenue splits are executed automatically and transparently through smart contracts. To me, the emergence of a project like this signals at least two things. First, the loan competition is shifting from a one-size-fits-all platform war to a more specialized problem-solving race. You don't have to do everything, you just need to solve a real pain point in a specific vertical to have a chance. Second, it shows us a very concrete use case for how crypto and AI can work together. AI is responsible for the explosion in productivity, and the blockchain can provide a foundational system for fair, transparent value distribution and ownership verification for that explosion. This could be the most tangible path for Web3 to empower the real economy and empower creators. Although the project is still very early, this is a direction I think is absolutely worth keeping a close eye on. Alright, that's all for today's Web3 Daily. If you found this helpful, be sure to hit that like button to show your support. Every day, we're combing through the noise to bring you the most important stories in the Web3 world, the core insights that are closest to the money. The goal is to help you make smarter, more rational decisions on your Web3 investment journey. Also, I've dropped some exclusive registration links for major exchanges down in the description below. We've secured some high rebate deals for our community here, which should help you save on some trading costs. Let's all stay rational, keep moving forward, and get wealthy step by step here in the Web3 space. I wish all of you steady growth in your crypto portfolios. See you all tomorrow.